It's definitely different or going much higher than everyone's expecting. We see the gold breakout this past week, and that's a smoke detector telling you that we're basically in a sound money renaissance. People are waking up that you want scarce assets, and I don't think you can put that back in the box. The reason why we're only a $2 trillion asset is because custody hasn't been figured out.
The Blockworks Digital Asset Summit, crypto's premier institutional event, is coming back to London this October, the 13th to the 15th. You'll hear from top names across global finance, DeFi, and policy. Think BlackRock, Circle, Coinbase, and the UK Parliament. Notable speakers already locked in include Danny Masters from CoinShares, Jeff Park from Bitwise, and plenty more to come. There's also a VIP dinner on October the 13th. That's for speakers and VIP ticket holders only. It will sell out. It's all happening at the Old Billingsgate in London. Use code SUPPLY100 at checkout for £100 off. Quick reminder, nothing said on Supply Shock is a recommendation to buy or sell any investment or product. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. Hey everybody, Pete Rizzo, the Bitcoin historian on X today. Welcome you to another great episode of the Supply Shock podcast. We're keeping it coming with the hits. We've got Michael Tanguma today, co-founder and CEO of Onramp, a Bitcoin asset manager that is helping lead the next wave of institutional and individual adoption for Bitcoin. We're going to get into a number of topics today around custody, of course, the price of Bitcoin, and the nature of the cycles. It's been a hot topic on the podcast of late. People chiming in. Is it over? Is this time different? Michael, welcome to the podcast.
Thanks for having me on, Pete. Excited to chat about all of it. Hoping we can keep it spicy and people engaged. I have no shortage of takes that I think are a little bit different for the traditional market. And I think we'll probably be somewhat aligned with your thesis in background being kind of more on the Bitcoin or the more maximalist side of things.
Let's hit it with, is this time different? It's been the big topic of conversation on the podcast. We had Matt Hogan from Bitwise come out and sort of boldly declare that he sees, institutional adoption essentially overriding any of the cyclical nature of Bitcoin's supply issuance. We had Adrian Morris, an independent analyst from the Master True North Group, echo that, essentially giving his case that we're headed to $1 million and a stairway to heaven. And then, of course, we have the con side. We've got Michael Turpin, who was on recently, sort of, talking about how he's selling at the end of the year, going to be rotating back into cash, then back into Bitcoin, essentially trying to time the top. So where do you fall on the question of the day? Is this time different?
I've been hesitant to give the answer I am going to give, but I recently just finished recording another pod and I was, for the first time, shared this. It's definitely different or going much higher than everyone's expecting. My case for this and why I had historically been hesitant to say is because I think most people were very wrong in 21 and we had it was kind of an anticlimactic blow off top. But my case has always been if sovereign bid steps in, independent of SBR in the US, but US I think would follow suit, you naturally have a different cycle because sovereigns don't sell hard assets. We see the gold breakout this past week, and that's a smoke detector telling you that we're basically in a sound money renaissance. And, institutions and sovereigns are stacking gold and they're going to start stacking BTC. And if that happens, that completely changes the narrative around everything we're talking about here. And you end up in much higher highs and then higher lows in the sense we don't see these crazy, we're not going to go to $1 million and then go back to 100K effectively.
Well, interesting. I know that, there's been a lot of talk about this, mostly, all smoke, no fire in terms of, the proof. We did see Mobadella from, the UAE come out and obviously make an allocation to the Bitcoin ETF holdings. But the rumors are, that the sovereigns are here. Why aren't we hearing about that if that's the case?
There's a few things happening. So I was in Dallas yesterday meeting Commissioner Hester Peirce is really an advocate, obviously, for the space, but also really puts out to the pavement and meets with, different folks in the space, actively building, hearing them out. And we had a roundtable discussion, and there was the natural understanding, whether it's banks, sovereigns, RIAs, institutions, And also individuals, we're still so early. We haven't seen even retail come into this. All this bid has naturally been from, you see the DATs you talk about, and then the, ETFs, which have been heavily retail, but heavily retail from like a space that's been pent up demand. It's not the natural retail we've seen in historic markets. And I think that's a product of like the reflexivity and the price. So as the price moves, you naturally get retail coming in and the exuberance, and that's been muted. And I think it's through options and other things. So it's just been a very slow stairway. Anybody listening probably within your network that's outside of the space hasn't really been talking to you about Bitcoin at the margins a little bit. It just takes time for these things to build consensus within these large organizations. And the sovereigns, I make the case, have stepped in. The way they stepped in was proxy it doesn't get talked about enough, but the hash rate is an example, because it's been understood that in the Middle East, they've been mining and potentially with nuclear. You see Bhutan, you see Russia. And so they've been using their natural resources to accumulate BTC. But I still think it's very early from the sovereign bid. But the second you start to see, specifically, we know the SBR is still being worked on. If somebody like the US comes out, that changes kind of the dynamic, I think, from a sovereign perspective.
Well, we did have Scott Bessent come out recently, essentially putting the lid on it, saying that the U.S., maybe wouldn't be looking for ways to accumulate, at least not selling, which is positive over previous administrations. But you do really think is the emphasis on the U.S. We won't really hear much about what's going on internationally until the U.S. moves, maybe.
Yeah, I mean, I think the ultimate version, we had Groman on recently, and he, talks about it along with others, is gold is the smoke detector, right? That there's something going on from a just traditional sound capital preservation of wealth and effectively sovereign debt crisis. There's just the money's no good. And so Bitcoin is just that natural, it follows, it usually lags in what gold does. And we've seen the gold accumulation. There was a recent chart that came out this past week with China. It looks absolutely insane. It looks like the hyperinflation of a currency where the amount of gold they've accumulated. And so I think it's a logical progression, whether it's the US or not. We saw this with El Salvador. This generally happens in any technological wave, that it's always the emergent challengers that are going to step in. They have less to lose. But I can't see, independent of what Bessent says, the amount of inertia we've heard from BPI, the different people there. I was just in a meeting yesterday where somebody shared in confidence that there's some stuff being worked on from the legal perspective of the SBR. So I don't think that it's completely like just moved away. It's just effectively gotten pushed for a number of reasons, because also I think we forget we live in a bubble in this space, and there's a lot of other issues we're worried about. And that's where the notion of gold was always going to be the leading indicator. It's such a much larger asset. It's still been money for thousands of years, that where gold should be the leading indicator for individuals to recognize that as sovereigns and institutions. Harvard came out with a $100 million position in gold and BTC. You're naturally going to see a higher beta play out, where that same thesis is the same thing. It's just Bitcoin's gold with wings and has higher reflexivity because of its finite properties.
Well, of course, the counter has been, that we've seen the older whales have been selling, in size. So, does the sovereign bid counter that? I mean, the 80,000 Bitcoin whale, these are big holders, no?
Yeah, I mean, it's a good point around the distribution of BTC, where some people may look at that as a bug. I think of it as a feature. And there's been holders that have different price points that have accumulated, at dollars, pennies, tens of dollars. And whether it's 10K, 50K, 100K, there's just these different thresholds where they're releasing. It's an interesting market dynamic. I'm not an expert in this, but you've seen some of the rumors where like they're cycling into ETH and these other, and you've been around much longer than I have, that these very sophisticated long-term holders know how to play these cycles and will go in and cycle into altcoins, and they'll naturally play that back and forth. And so I don't necessarily know there's a lot of just like, I think we've probably exhausted a lot of the selling, but again, nobody really knows the price. All you know is price goes up because there's more buyers than sellers. I do think that there's something to the stair stepping that we've seen has been a little bit more structured. And I think that is intentional, however it's done, in the same way gold has had a lid for a long time. You can't really do that with Bitcoin, but it would be the way, if you're going to accumulate it from a sophisticated level, how you would see it. But I only think it's like the metaphor or whatever of a beach ball underwater. You can only do it for so long.
Well, it certainly seems like we're in a longer cycle. You got to figure the first all-time high of this sequence, maybe back as far back as April 2024. So, we're coming up on, a year and a half plus of bull market. So it sounds like you think that even, next year we could get higher price action, and we don't see that 50-60% drop that we've seen in the past.
That's at least the base case where I'd stick my neck out and make it a bet effectively, right? Put your money where your mouth is, that this cycle is going to last much longer than everyone's expecting. We've already seen this play out. Like, it's a very weird timeline from the common narrative of supply shock with the halving, and then you go into whatever it's post that 18 months and where we should be. I still think we'll have a nice Q4, but the reality is that this has been elongated. The volatility has been suppressed from whether it's, again, institutional products like options, along with the selling. But just from behind closed doors, and this is like public information, but banks are coming online. But there's still such a process from the liquidity piping to even RIAs. RIAs still have to go through a crazy amount of hoops to get ETFs approved, listed. You see the OCC is another great example. Everyone's bullish on banks and the new Genius Act, but the reality is there's still a lot of inertia from a lot of institutions and individuals that wanted to get into the space, that there was that stigma of getting exposure to Bitcoin, that they're still waiting for certain regulators and different people to like give them the green light. And so the only thing I could see where that would completely cut it off and not have an increased inflows into 26 and deep into 26 into potentially 27 is if some crazy like FTX thing happened. Because I think most people know that's what happened in 22 is there was a lot of people wanting to step in the market, and then the market literally just like fell apart, and people conflated that with Bitcoin, and then it got stigmatized again where nobody wanted to touch it for a few years. So if something like that happened, that would be like a black swan event. But I don't necessarily, the amount of inflows, and again, I look at this as a global macro thing, even though I'm not a global macro expert. It's like there's writing on the wall that inflation is persistent from retail, like an individual perspective. Everyone knows what it costs for a house, mortgage, insurance, food, all the way to institutional investors. Again, Harvard being one of the most sophisticated endowments in the country and the world, putting a material allocation, $100 million position in gold and Bitcoin. It's above their NVIDIA and Google allocations. That's like, again, the signal through the noise of like people are waking up that you want scarce assets. And I don't think you can put that back in the box independent of like market cycles. That's a different narrative entirely.
Yeah, it's hard to know when these things are going to become trends, right? You get these individual data points. Obviously, you got Harvard coming in the market, Brown University, feel good stories, smart money is coming. But we've seen pensions tepidly allocate. As you said, as far back as 2021, 2022, then FTX happens, that drawback comes. I guess as you look at the infrastructure in the market, right? So this idea that maybe, Bitcoin expands, we get a bull market, and then it's some sort of intrinsic infrastructure weakness that causes the decline. So looking at the board, you don't see any infrastructure weaknesses this time around. You think that the custodianship and the quality of the exchanges and custodians is high enough to avoid that?
No, you're setting me up perfect, because that is like how early we are. The case we make and we talk about is that custody hasn't been figured out. This is actually the delaying confidence. What I was talking to Commissioner Pierce about was we're so early to Bitcoin, we actually haven't figured out custody. The solutions that have existed are two-dimensional solutions to a three-dimensional problem. And what that means is you have self-custody and you have third-party custody. So you have Coinbase or you have a ledger. And that's no different than 1,000 years ago, where you can put the gold underneath your mattress, or you can trust the goldsmith. With the goldsmith started about 400 years ago, so not less than 1,000. But there's a reason why banking existed and goldsmiths existed, because people don't want all of their gold underneath their house, buried underneath the backyard or put under the mattress, because people come and take it. And some of my good friends we talked about before, recording, that are friends and popular in the podcast, or podcasters and people everyone preaches the not your keys, not your coins. And there's some truth to it, but there's also reality. Nobody's providing a solution as the asset gets to hundreds of thousands and millions of dollars and the market awareness is there. What does that look like in the future? And we've seen this with the price run from that 60 to 100K, the Ledger co-founder getting his fingers chopped off, and the amount of kidnappings. In general consensus is understood that for every one that's reported, there's 100 to 1,000 that happen. And that's just a broken sign of market structure, in my opinion, because nobody kidnaps Jeff Bezos or any individual for their equities. Think about like trying to liquidate your bond portfolio. I know you don't have one, but if you did, like think about the time you would have to kidnap your family member, take you, You'd have to get them to authenticate the transaction, move it through the financial system, get it into the banking system. Then you have to get them to go get a black duffel bag to get those dollars. It just doesn't happen. And so the other side of it is third-party custody. And we definitely know you don't want to do that with material wealth because naturally, again, that two-dimensional problem and then three-dimensional or two-dimensional solution is private keys are just data. And at the end of the day, everyone would either publicly or privately will say most data, if not all data, will be leaked at some point. We see this with everyone's PII, right? AT&T, like just everyone at a certain point, CRM. And so that's what private keys end up happening, whether it's malfeasance, negligence, collusion, these things ultimately end up happening. We've seen this across the board. And so what we work on and where I've been very excited, my background was building collaborative custody solutions because I naturally needed it. I got into this space around 17, built a material position, and I didn't want to be alone on an island and hold one of these things, with all my wealth in it. And so I ultimately had to seek out other solutions, and that's where collaborative custody, it's multi-sig with assisted help, right? But what I found was as we were building that, the reality is you hit a barrier, whether it's a high net worth individual that just won't do it or hates and does it begrudgingly, or you go even higher and you get to any kind of corporate structure that manages other people's capital. And they're like, this is insane because you have seed phrases, harbor devices, you have churn if somebody leaves.
Well, it does seem like there's been a bit of a referendum on self-custody this cycle, right? If you think of the themes, the ETFs, Bitcoin treasury companies, 2021, 2022, as you mentioned, these podcasters, we know we kind of grew up with these maxims of now your keys, now your coin. It seems like a lot of that's going away.
I would say it is, but I don't think the solutions have been presented because to your point, I was just in a room yesterday with the family office and they were explaining to me how 3 of their peers with very large holders sold all of their positions, went into an ETF. And I would say that's much worse than figuring out the self-custody. I would push an individual there because at least you can, if you know what you're doing, you can mitigate. There's still tail risk. There's still loss, getting hit by a bus. There's still, a lot of things that can go wrong. But when you think about a taxable event from liquidating a position and then going into multiple layers of counterparty risk that exist with an ETF, because you have the issuer, you have the brokerage you bought it from, and then you have effectively the third-party custodian, is still ripe for the thing that most people forgot. And I'll never forget because I was in the middle of building and seeing the market just completely delever, is everyone thinks 2022 was solved. Like, this is where I've always loved Safe for being a little bit polarizing. He was like, SBF should be free. Like he should have never gotten anything because the market would have been like, oh shit, this isn't actually an SBF problem. This is just people speculating, all the craziness that happened in 22. And my base take is that was a dry run for what we're going to see, meaning we're going to see craziness, and we're already seeing it with the DATs at this early stage, but we're also going to see the rehypothecation, the BlockFis, the Celsius, because nothing was structurally changed from you still have centralized custodians managing a digital bearer asset. And the kicker is there's no bailouts. That's the thing that what's happening right now when people go into DATs and ETFs is what they're telling you is they don't want the risk. So they're pushing it out to the third parties, whether it's the DAT company, the execution of that management team, the underlying custodian, or BlackRock. And that's ripe for just a lot of misery because ultimately we know animal spirits, and it's just like the way you don't print more money is you don't let people have the money printer. In the same way, if somebody has a centralized pot of all these goods, there's no shortage of reasons why you want to generate additional yield, or it just becomes a honeypot. The ROI goes up from collusion or people to attack. That's the paradox with Coinbase is the more successful they are, the more likely they are to fail.
Well, so maybe you can explain the mechanics to me a little bit here. So I get it, right? Capital's accruing in these Bitcoin treasury companies. They're acquiring Bitcoin. Essentially, that's a way to defer custody to these new institutions. Are you saying that they're going to look for ways to put that money to work? And then that's where that sort of, kind of custody risks like really comes to the fore, because essentially they'll need to, maybe find some ways to make this capital, put this capital in the market. And that looks like lending and other types of products like that.
The basic angle is we've never had a digital bearer asset that's worth $2.2 trillion. And so we've already had it at 1 trillion or whatever it was in the past 15 years. And it never worked out for centralized entities to hold the money because you can list 10 different ways, whether it's Quadriga faking the death, whether it's FTX and being a complete Ponzi, it's BlockFi mismanaging and rehypothecating the collateral, right? Like you can go down a laundry list of different ways that it can go belly up. So the tenant we make is something called multi-institution custody. It's really elegant because the base case of this is that it leverages multi-sig. Multi-sig is battle tested. It's interoperable. It's native to the Bitcoin protocol. It's not a smart contract. That's really key because Bybit had the largest hack in human history, $1.2 billion. They use multi-sig, but Ethereum doesn't have native multi-sig. So it was effectively a smart contract on top that was manipulated. The point being is that Bitcoin is special, and this will be getting to some of the spicier or like at least a little heretical takes, is the difference between Bitcoin and gold and why Bitcoin will be money is not necessarily because there's only 21 million, because you can make the case 19 million would work or 22. And I'm not saying there's a tail mission needed, but even if you put some inflation rate, gold had inflation and it worked perfectly as money. The reason gold failed is because it's centralized, because it naturally doesn't scale. Bitcoin has the ability to insert governance at the asset layer, at the protocol layer. What it's been used for historically is multi-sig is in-house. So an institution has all three of the keys if you use 2 of 3. So, Coinbase, BitGo, whoever. What we take is you split the keys with different institutions. And so you have 3 layers of effective security. You have base level, governance at the technical layer that you could never have. But then you insert on top of that legal governance, because if you're a client or an institution's a client, they have direct legal arrangements. And this is all through a unified experience. You're not having to work with all these institutions, but you have direct legal arrangements with each key holder. So whether we work with pubcos, institutions, endowments, and individuals, the Bitcoin's titled to them. It's theirs, on-chain, auditable. But then the institutions will only sign and go into an offline ceremony similar to any other large custodian if the individual video verifies with them. And there's other permissions they can enact. And so where the last layer of security, so technical, legal, is just game theory, because every wallet is insured and segregated. And why that matters is because our large client has over $250 million in assets. But the point being is, even if it was $1 billion, BitGo is our largest custodian that we partner with, in multiple qualified custodians that participate in this. They hold over $100 billion in assets. They're about to IPO. It makes 0 sense for them, for their business model, to rug and collude with another key holder, which would require 40 to 50 people on both sides, right? It's not me and Mike Belshe holding a plastic device to sign assets. And so I share that with you because that's how I see basically a standard forming in the industry that has no standards when it comes to how do you secure the assets. And that naturally brings market structure for individuals to not be attacked, because it takes time to move the assets. In the same way you get consumer protection, whether it's an ETF, which I was talking to the commissioner yesterday about, or a publicly traded company. There's a lot of them doing things the right way, but there's a lot of them not doing things the right way. To your point, to get the NAV premium to rise, you naturally have to go further out on the risk curve. That's the thing that doesn't get talked about, is the DAT companies are closed-end funds. That's effectively what they are. And any closed-end fund should trade at a discount to NAV, because you have management fees, which, by the way, BitMEX did a great research report on some of the DATs that some listeners are probably in that are getting crushed by their management fees and how they take from there. It's not so theoretically they should be much lower than 1x NAV. So what you have to do is go further and further on the risk curve. And as you go further on the risk curve to generate that yield, that's when you naturally end up in bad positions. And then they don't even have to go further on the risk curve. They just trust the wrong custodian, spin up their own multi-sig or whatever, and they don't do it properly and they lose the assets. And that's something we talk about a lot, because most retail investors don't even know that custody is an actual problem in this industry, because they were just got in the past couple of years.
Well, in a lot of respects, other than the Quadriga CX, it's been about, half a decade since there has been, major incident, at least one that was reported, right? I struggle even to recall the number of incidents that have been public. BitPay maybe back as, 2014, 15, I think, at a high profile executive phishing. But, a lot of this has been, undiscussed because there hasn't been, much of a problem. So I guess what makes this come to the fore? Is it the volatility? But it sounds like you don't expect volatility in the market. So what actually brings these problems to the forefront? Because last time it was volatility.
Well, they do happen. The most recent one that comes to mind. Well, so there's different forms again. So because we've never had a digitally native asset worth this amount of capital, the reality is there's no bailouts in Bitcoin. So that's the reason why custody matters so much, is because there's nobody to step in as a lender or a buyer of last resort to backfill if there's losses. This ties into another heretical statement around proof of reserves is just a fallacy. And the reason why I bring that up is because anybody can just audit and say, oh, I have proof of reserves. But tomorrow, if your intercompany colludes or you're hacked, well, what was the point? And what we talk about a multi-institution is inherent proof of reserves. It's the first time multiple institutions have coordinated to build the wallet. They're attesting to that wallet is not only yours, but you can always audit on chain. The last one that happened was about a month ago. It was a Indian-based exchange, had proof of reserves, and they lost like $60 million. So there's those, and then there's naturally the rehypothecation and the other things we talked about that happened in 22 that were BlockFi, Celsius, FTX, Genesis. Like there's a lot.
But does the rehypothecation not happen in a world where you have more collaborative custody? Is that what you're saying?
Well, it inherently can't happen unless it's part of, you would have eyes on it, but also you'd have to participate in it. Specifically, like let's say you had a wallet that was, you set up, you onboarded with Onramp, you have a multi-institution wallet, like legally and technically assets can never move without your permission. So that just generally can't happen. And that's ties into a thing that TradFi fully doesn't get yet is whether you have Fidelity or Coinbase, they work in omnibus fashions. These things aren't talked about, right? So we're getting in the weeds, but you basically have multiple wallets that hold billions and billions of dollars. So that's where most people don't know insurance is usually BS in this industry, specifically at that level, because you have like a $250 million policy on $100 billion in assets. You're never going to be made whole there. That's where you can get a lot of different things, whether it's social engineering, phishing. That happens all day long with Coinbase accounts, but nobody talks about it because that's on the individual. So that's another example of how assets can be lost. To your point on just general losses because of market structure, you insert 2.5, 3 trillion, 3.5, $4 trillion assets, right? That's where I think everyone believes we're going. The level of sophistication from whether it's bad actors trying to take the Bitcoin or as animal spirits come in, these concepts and principles that we're talking about that you know what I'm saying, probably half the listeners maybe understand half of what I'm saying, is that they're new to traditional finance individuals. So like the joke I make is the people running BlockFi are running the new show in today. They just have better suits and better hair gel. Like what did they do any different? Have they started? We're just starting with the lending market coming back, the amount of capital coming back. Traditional finance, all they know is making money on money. So if somebody's going to give up their Bitcoin for collateral to take a loan, well, they're inherently incentivized to go re-lend and make money on that underlying. And the problem is that the individual taking the loan out, unless they've gone through these cycles and understand why you want it non-rehypothecated on chain, they're just generally going to an interest rate that's going to be lower. And I experienced this visually when I used to compete against BlockFi on the lending side. Our loans were 9.9% non-rehypothecated on chain, and then BlockFi's were 7.9%. And it would have to say, nominally it's much cheaper, not much, but 2 percentage points cheaper to go with BlockFi. Risk adjusted, it's much cheaper to go this route. And people learn the hard way because we never suffered a loan loss in my previous firm. But at BlockFi, obviously people were left holding it back for a while.
So I'm trying to build this into a narrative though, because it sounds like, you don't think that we're going back to lower prices, but you're concerned about the custody risk in the space such that, it sounds like you think there's the potential for another FTX like incident. And so it sounds like where you think that occurs is with just to make sure I pin this down, it's with these institutions that are now sort of, following the Saylor playbook. They're taking on this debt. Maybe they're, in the long tail digital assets doing the same. And now in order to kind of compete in this race that we have between these companies, there's the pressure to deploy that capital and put it to work. Is that essentially what you're saying?
Yeah, I would go at the base level. The reason why we're only a $2 trillion asset is because custody hasn't been figured out. Because if you think about it, like from your peers that are not educated about this space, general consensus, it still exists that digital assets or Bitcoin are at best speculative. And you hear this even in the common themes with the Dahlias of the world and others are always telling you 2 to 3%. And we talked about this with James Safer, we had on the pod, and he was referencing they're writing a book. Those guys are going down the rabbit hole in real time, him and Balkunis. It's great to see, but they're writing a book post ETF world and what happens. And they talk to all these individuals that say, 3, 5, 10, 15%. When they ask them, what's your portfolio? They're like 50+%. And where I'm getting at is that think about how great product market fit Bitcoin has, that we got to a $2 trillion asset. And people don't know if the underlying is going to evaporate overnight or not, because they don't know if the custodian is going to exist. Like objectively, if you put all the custodians on a wall that have existed for 15 years and put a blindfold and threw a dart, you would you would, in a probability sense, hit somebody that's already gone belly up, that's gone. There's not a lot of custodians that have a track record of 8+ years, like a Coinbase. So the point being is that people look at this as a speculative asset, not because the underlying fundamentals aren't right, that there's only 21 million. It's not hard to understand Bitcoin. What's hard to understand it is once you get it, now you have a personal problem of how do you put material capital. And this is the part that the Bitcoiners don't get, is 12 words in self-custody is not hard if it's $10. Or if you're worth $1 billion and it's $10 million, it gets real hard if you're worth $1 billion and you need $250 million because that's material, 25% exposure. And then that's when the problem happens. Are you going to trust a third-party custodian, even if it's Coinbase with it? Are you going to put it in self-custody? And that's why empirically, like on chain, over $1 trillion in this asset sits on these devices because this has been the most sophisticated way to custody. You sever the internet connection. And what I'm saying is that in the future, the next 15 years, the existing models that how we got here won't work with the amount of size that's going to come in. Now, to your question about how does it actually fall apart? There's a number of ways like that we don't even know of. There's unknown unknowns. Like think about Plus Token as an example. Like remember Plus Token? I still don't fully understand it, but it was a Ponzi in like Asia Pacific, and it was back.
Someone that was like responsible for a huge amount of Bitcoin transaction fees at one point.
Yeah, it was a crazy. It was part of the like kind of like false top when everyone thought we were running in 2019, and then the market basically went to that 12 and then back to 4 or 6 or whatever. Point being is, we're in the Wild West still in this space. And I don't think people understand that. And so the reality is that there's an incentive for this like digital bearer asset, and there's no shortage of different ways. And the easiest way that I can claim that it can happen again is whatever happened in 2022. The thing I would throw back to anybody listening or yourself, if you want to share, is like what changed in 2022 versus now that would cause us not to have what happened in 22 happen again.
Well, my impression of the market is there does seem to be less consumer lending, right? There's less excitement about products like BlockFi. There's less, you just don't see products like that anymore. Of course, you have, some folks who are engaged in that, business, but it doesn't feel like the focal point. It seems like people have realized, the Bitcoin return rate, should be robust enough to offset, obviously any sort of interest that you get on that. I think the one question that I have, though, as you pointed out, is with these companies where I think it's literally going to be their fiduciary duty to try to outperform. Because if you have 100 companies, 30 listed companies in the US that all hold Bitcoin, the pressure to differentiate, means that they have to generate additional ways to stack Bitcoin, right? Essentially, that's where I could see the pressure kind of ramping up in kind of a way that you're saying, but maybe not so much on the retail side.
Yeah, I think the other way, that's a narrative that's slowly starting to creep in, and it came up yesterday, is on the crypto side. Like I would posit it's all noise. Like it's just different levels of noise, from Ethereum to going to whatever real world assets, whatever is coming about. And there's a theme that's starting to transpire. You see this a little bit. I think the New York Times had something with Trump and his allocation and like how they're making money. And
well, that's why it's feeling pretty late in the cycle to me. You have this big, the big deals with like, crypto.com token and doing a public company with, the Trumps for $8 billion. These are kind of things where it's easy to overlook them, but then, it does feel like the later innings, so this is where I get the pull for the 4-year cycle again, where it's, we've got Pakistan mining Bitcoin. We've got, all these companies, public companies just passed 1 million Bitcoin. It's tempting not to see these as top signals, but I don't know. I'm second guessing.
Yeah, I think where I see the other side of that in particular is the Trump group is not crazy all the way to Lutnick getting inside Tether and the Genius Act passing. That's the signal that this is going to run much harder. And so they're sitting on boards and getting involved is not at the top when this is all going to, like, this is them placing their chips, knowing where the market's heading. But this ties into the second part of the collapse is it came up yesterday about, well, everyone like in crypto, again, you pick whatever area that you're focused across crypto. And I think you're closer. You're in an interesting spot because I think you actually work with Blockworks. There's a whole business model around
the crypto folks. Yeah.
Yeah. And I've known Jason and Michael since back in the day when they started the business, because I was in New York, and those guys, I love them. I think they're hustlers and very good entrepreneurs. I was actually at the block randomly with Frank for about 6 months. That was my entry point into the space.
We say the only thing that can cure the crypto curiosity is time, right? It's
Yeah. Is that you speaking to them through the pod?
yeah, it's the only answer, really. We all thought a lot of things were going to work.
But where I'm going with that is like everyone's Ponzi or crypto is not theirs. In the sense of that, if somebody's in one, like the thing that came up yesterday, well, what's an unregistered security? And people get excited that this new market structure is going to say meme coins aren't unregistered securities. But then what's a pump and dump? And I didn't want to like be antagonistic in this room, but it was like, well, what's the difference? Help me understand where your line is. Because now you're starting to see with this new market structure that's going to come about on the notion of a token is a token. And then, there's a lot of things that are going to be deemed commodities. Where I'm going with that is we're opening up and people are already starting to fear the Pandora's box of the Wild West that's going to happen. And we're just starting to see with the favorability to this asset class, crypto and digital assets. Well, most of the firms that we see they can't raise venture capital. They can't, there's very strong inertia to offer the whole long tail of crypto assets. And so you see where I'm going with this. Like, well, now if you have all these things happening, you have different cross collateralization, you just like open your exposure and risk to different things that can bring in counterparty risk into the industry. And that wasn't necessarily the BlockFi, but just giving you a lens into as you start to get further and further out on like what is going to be brought into.
I think we're about to see a real wave of ETFs, right? I think that probably the top 30 to 50 crypto assets will be turned into ETFs. Those will be rebatched into other ETF products. Coinbase, selling stocks plus crypto type hybrid products. That seems like it's gonna be an interesting cocktail.
That's exactly right. And then the narrative of tokenization is going to happen, and so now you obfuscate. Like you're going to have effectively tokenized Bitcoin because that's what an ETF share is. But now you can trade it, margin, lend against it, go in. And that's just natural human psychology of we've seen this for 15 years where somebody gets into Bitcoin and then they naturally from unit bias to gain start to filter into these. And we've seen this with the treasury companies, right? It started with Bitcoin and MicroStrategy. And now we have the most insane kind of DATs that feel like every day are being launched. And when those start to become interoperable with other assets, and then you now have leverage built in. Like, again, I haven't thought through how this looks because we have a focus of something else, but you could see how that really gets messy when you're using them for margin and collateral. And then the underlying isn't appreciated on how you custody it. And then you have the incentive to take the underlying and go do other things with it. You end up in, again, my base case is what happened in 2022. It'll be 10x the price like Bitcoin. So we'll see, hundreds of, or tens of trillions of dollars in market cap for this industry, but that naturally nothing's systematically changed in the market structure and transparency and in investor intelligence and like what are the right products and how do you go about it. The people that have been in this space know, but there's still so small market penetration that, and this is a funny thing we're talking about because me and our chief strategy officer, Brian, he came from a private bank. And we argued for 12 months about this exact thing. Like he believed that nobody was going to come into altcoins. There's not going to be any other cycle. And we got like a little bit combative, but it was like, how can you say that? Because we've gone through this, but it's only 1% of market knowledge understands that Bitcoin is a signal. So when the market forces come, how are we going to expect them to understand?
I do think the augmentation on that I've come to is I think that you at least won't see another large L1 capitalized from zero like you saw with Solana. So I think even if there is a run into altcoins, it does feel like the venture money is frozen up and there's not a willingness to sort of bet on a new horse. I think to me, it really does feel like a Solana, Ethereum, Bitcoin, three-way horse race. Obviously we know Bitcoin, will emerge as the winner, but like from the public market perspective, it seems like, it doesn't seem like there's going to be a fourth entrant, right? I think like when you think about stable coins and, some of these new blockchains that are coming out, I think it was Stripe or some major financial institution today, launching one, but it's not going to have a token, right? It's just going to work with stable coins. So I don't know. It'll be interesting to see what happens, but I don't expect to see another large L1 kind of enter the top 10 or make a big push. So I do think it's changing a little bit, right? I don't think there's going to be a willingness to start something new, but the digital asset companies prove that I think, there's always a rotation, right? So hard to know where that comes from, whether that's new participants or old participants who are just savvy, right?
Yeah, I hesitate to take that stance simply because I've seen it happen twice where there were really crazy calls where friend Marty Bent called peak clown world about 5 years ago, and it's just got insane. And then Brian said no more alt season. I think you probably take the stance with Bitcoin and ETH.
Well, I think you're gonna have an alt season. I just don't think you're gonna have a very compelling, like, sort of new alt that enters the conversation. So I think like it's happening, right? The lack of confidence in alts is happening slowly, but I think where it happens is you don't see a new entrant. You're going to see a lot of enthusiasm about the older entrants, but I don't think there's a newcomer coming this cycle.
Where I'm going is I'm not saying there will be, but I could see how there could, whether it's like all this narrative. I got like Hyperliquid pilled or tried to get pilled yesterday with somebody who was very evangelical. That's a hardcore Bitcoiner. And then also, what about a world where BNY, JP Morgan, and whatever set up some kind of like blockchain that's an open blockchain that has a token attached to it? I wouldn't call like that there's no more blockchains, especially you mentioned there's like Paradigm and Stripe and all these, new stablecoin rails that you attach a token to one of them. And I don't know, like I don't necessarily like follow and wouldn't want to see another one, but I just hesitate with such small penetration into the digital asset space that people won't try new things and put new narratives, because that's what all this stuff trades on. It's just vibes.
Well, they're certainly running out of vibes, but winding down here, it sounds like we're optimistic about next year. Maybe you can just give us a couple predictions, through the end of the year.
The one that I was hesitant, but I shared in the beginning, is I think we go much higher than most people are expecting. It persists longer. And we do see very big blowups and big. I think like the thing to take away that would be a little spicy is 2022 is the dry run. Like 2022 was inorganic in the way it was set up with SBF put in place, and then the way that things fell, and the blessing with Coinbase. And we just saw this past week with the offshore derivatives now just conveniently being opened up to U.S. investors, and Lutnick sitting with Tether. Like there's been a lot of clamps behind the scenes with a lot of the structure. So now you basically have the U.S. government has blessed this industry. And so that's part of why you're going to see it go much larger. But I also think naturally you're going to see a deleveraging of epic proportions as well. So the main takeaway I would say is to be careful of where you park your assets.
Hold your Bitcoin in self-custody or collaborative custody, I suppose, right?
Yeah, I would say just do your research and know, kind of don't follow any one advice. Just kind of like figure it out for yourself. I think most people just follow the trend and feel like attached to they have to self-custody or they have to leave it with a third-party custodian because it's fidelity. But the reality is, once somebody pragmatically goes through it, you kind of naturally end up in better solutions.
Well, Michael, appreciate that. Speaking of what's next, we've got the Digital Asset Summit coming up in London this October. You can go to blockworks.co/events. Find out more about all the great speakers in store. Certainly will be a thriving conversation there about Bitcoin and crypto, digital asset treasury companies and Bitcoin treasury companies. I'll be there bringing a Bitcoin perspective to the event. For now, this has been Supply Shock, a Blockworks podcast.
Love it. Thanks, Pete.